Morning, guys. It's Tuesday, July 22nd, 5:24 a.m. Central Time. Grain markets mostly lower this morning. December corn futures down 3.5 cents at 4.18 and 3/4. November soybeans down 1 at 10.25. December Chicago wheat down 3.25 at 5.60. December Kansas City wheat down 1 at 5.47 1/4. December spring wheat is up a half cent at 6.09. China is cozying up with an African country as it relates to corn and soybean production. Why don't we start there?
Right. So, a Chinese state owned conglomerate is set to develop large scale soybean and corn farms in Angola. Citic Ltd plans to invest $250 million over the next 5 years to develop approximately 247,000 acres of farmland. Around 60% of production will be exported to China, with the remainder used for domestic consumption there in Angola. The state-owned conglomerate will use high-yield farming technologies to optimize production. The Angolan government plans to sign additional agreements with Chinese firms, aiming to eventually export more than 500,000 metric tons of food products to China. China and the U.S. have agreed on a framework to resolve trade tensions. However, a final deal has yet to be reached.
Angola is on the west central coast of Africa, not really very close to China. People are going to hear this story and they're going to say it's Trump's fault. Maybe it is. Maybe it is because of the trade tensions. However, China's interest in Africa, this is not the first go around. They started some of these projects in like the early 2000s. I think there might have been some stuff as early as the 1990s. They're not talking a huge amount of acreage, $250 million to develop 247,000 acres. That's not really a game changer or a needle mover here today. But for those of you guys who are going to be farming for another 20 or 30 years, this could probably be something that is a bigger topic of discussion in your future. Perhaps the way that Brazil was for some of you older guys, as they started to develop, in the 90s and early 2000s and turned into this massive powerhouse. I did a little bit of research. The soils in Angola and in this section of Africa are not similar to the U.S. Corn Belt. They're much more similar to Brazil's Cerrado region. So they do have the ability, of course, if the investment is correct, to go ahead and produce soybeans and corn and that sort of thing. So China's making some moves here, and all of the headlines that we do about China, it seems like they're pushing towards this like self-sufficiency. They don't want to be reliant totally on the United States. They don't want to be reliant totally on Brazil. I mean, they've got these relationships set up, but they want to be self-sufficient in the future. And China appears to have a very long-term view of this stuff.
Corn and soybean futures fell on Monday amid expectations of rainfall. The December 25 corn contract dropped roughly 6 cents, settling near 4.22 per bushel, while the November 25 soybean contract declined nearly 10 cents to settle at 10.26 per bushel. Although extreme heat is also expected across parts of the Corn Belt, the outlook for rain appears to be outweighing concerns about potential crop stress. Wheat futures declined as well, driven by increased Russian export activity. However, losses were limited due to Bangladesh announcing last week that it plans to increase U.S. wheat imports over the next 5 years.
Let's look at a couple charts. Here's December corn. So on, I think what would have been Friday last week, we went up into that gap from earlier this month. It was a Sunday night gap down, and we rejected that. So the market didn't even get up to that short-term trend line, and we've kind of backed off. Soybeans almost filled the gap from a few Sundays ago, tested some trend resistance, and have backed off. So what you'd really like to see from a technical or chart standpoint is go fill those gaps, trade up above those trend lines, and get something going. We're just not quite there yet. The heat wave as it relates to the Corn Belt has become national news. Here was a graphic that CBS had in its article. Here's where the corn crop is, right? And it's going to be hot in those areas this week. We talked about the Dome of Doom yesterday, and yes, it is going to be hot for the remainder of the week, the way that it looks. Our friends at Crop Profit estimate, based on GFS ensemble data, that U.S. corn country will run 5.3 degrees above normal on average over the next 7 days. And then the heat subsides a little bit during that 8 to 14 day period. I talked about the dome yesterday, and it is going to kind of center around the central corn belt here for a few days, and then it kind of disappears and another dome kind of reemerges in the western part of the country. Like you look at where the heat's going to be focused there, and Colorado and Utah and up in Montana, you're going to see some ridging there, but that's not really going to affect the crops. The rains are going to be locked out here for another 2 or 3 days, the way that it looks, but then your 3 to 5 day period, you have some stuff returning to the central corn belt. So the way that it looks, the market again is not concerned about the heat wave. The market is not concerned about some of the historically excessive rainfall that we've seen over the last couple of weeks. The market is focused on crop ratings, which are good. We're going to get to that in a second. Focused on rainfall, which has been adequate or perhaps excessive. And people just think this is going to be a monster crop, and maybe it is.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video?
Chris Barron was on yesterday. We did an early look at 2026 corn and soybean budgets. We did some other stuff too, though. We took a look at marketing for a new crop for 25. Where do farmers stand? What was the aggregate average for Chris's customer base in terms of sales? And what's kind of the game plan moving forward? The 26 budgets were interesting. We're still kind of aggregating information, and fertilizers is kind of a hot topic. We touched on that just a little bit. Chris touched on some of his best practices as it relates to margin and budget management and that sort of thing. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. It's information only. We just produce a ton of content when we want to send it out to you. We do an email every single business day that goes out at 5 a.m. Central Time. Our premium video blast goes out at 10 a.m. Central Time every single business day. We do everything from cash grain marketing to policy to crop insurance to farm budgeting. If you're farming and you're the decision maker, this is stuff that you need to see. Go to standardgrain.com, sign up this morning. Nobody will try to sell you anything else. Again, we just want to send you info. This is the best way to support what we're doing here on the podcast and on YouTube. We don't make a dime doing this. And in fact, we lose a ton of money. So premium subs, we love you to death. You float the boat for us. If you're not a premium sub, give that deal a shot.
U.S. corn conditions remain notably strong. As of Sunday, 74% of the crop was rated good to excellent nationally, steady with the prior week and well above the 5-year average of 64%. The rating was the highest for the week since 2016, and only 6% of the crop was rated poor to very poor, up slightly from 5% last week. The U.S. soybean crop was rated 68% good to excellent, down from 70% the previous week, but still well above the 5-year average of 62%. Excluding last year, when the rating matched this week's, it's the highest rating for the week since 2020. Only 7% of the crop is rated poor to very poor, up from 5% last week.
I'm going to tell you guys the same thing I told you last week as it relates to corn ratings. Yesterday's good to excellent rating of 74% is the second best of the last 10 years. Only 2016 was better. The national corn yield in 2016 was 4.6% above trend. The year that is just below this year in terms of ratings was 2018. In 2018, the national corn crop was 3.3% above trend. An extremely simple view of this, based purely on crop ratings, is that this year's yield will fall somewhere in between that 3.3% above trend and 4.6% above trend. The exact average of those two numbers is 3.9% above trend. If we're 3.9% above trend, that's a national yield of 188, and 188 is a big, bearish, scary number. That's not my opinion of the crop, but there are analysts out there who are working with that sort of number based, again, purely on the crop ratings, because there is some correlation between crop ratings and final yields. It's not perfect by any means. There's a lot of flaws here, but I think that there's still a large contingent of the trade who is working with a really big corn yield number. We're going to start to see the same sorts of conversations as it relates to soybeans because we're above average. I know we were down with the ratings a little bit yesterday, but we're still several points above the long-term average. It's a little bit early to be doing soybean yield modeling. You got to get into August and see some weather. What about wheat?
U.S. spring wheat ratings declined last week. As of Sunday, 52% of the crop was rated good to excellent nationally, down from both the previous week and the 5-year average of 54%. During the same week last year, the crop was rated 77% good to excellent. 16% of the crop is rated poor to very poor, up from 13% the prior week. Meanwhile, the U.S. winter wheat crop was 73% harvested nationwide through Sunday versus 63% the prior week and 72% on average. During the same week last year, 75% of the crop was harvested. Seasonally, harvest progress is the third slowest in the past decade.
There's some rains moving across spring wheat country this morning, North Dakota, places like that. I think Canadian spring wheat areas have caught some rain. So spring wheat futures have acted very poorly. All three of these contracts, whether it's Chicago, Kansas City, Minneapolis, they're all acting incredibly bad, which I think kind of continues to be somewhat of an anchor on maybe the corn market in particular.
Ag Rural has raised its forecast for Brazil's total corn production. The well-followed private group expects this season's crop to reach 136.3 million metric tons, a 4.4% increase from last month's estimate. The upward revision is driven by improved yield expectations for Brazil's second corn crop, which is estimated at 108.9 million metric tons. As of last Thursday, Brazilian farmers had harvested 55% of the second corn crop, a 15 percentage point gain from the prior week, but still well below last year's pace of 82% for the same week.
Monster crop being expected in Brazil. And I've heard numbers that are even bigger than this. So I mean, this jump from 130.6 to 136.3, that's a big jump in production. Some people think it's north of 140. USDA raised their estimate earlier this month. They're at 132. So the difference between USDA's most recent estimate and Ag Rural, that's 170 million bushels worth of corn. And that Brazilian corn production number, I'm told, could end up north of 140. And this is probably another one of the reasons that corn futures have had a tough time. Yeah, we're expecting a big U.S. crop, but also this big Brazilian crop appears to be getting bigger as time moves on.
The U.S. Is considering secondary sanctions on buyers of Russian exports, a move that could disrupt fertilizer supplies and substantially impact agricultural production in Latin America. Brazil and Mexico would be especially vulnerable due to their heavy reliance on Russian fertilizer imports. Brazil imports about one third of its fertilizer from Russia. Mexico also depends on Russian fertilizer, especially urea, which is vital for its corn and avocado crops. While both countries have launched efforts to expand domestic fertilizer production, progress has been slow due to high costs, infrastructure challenges, and underperforming state owned companies.
The last set of sanctions, I think, kind of carved out fertilizer because nobody wants to be responsible for a spike in food prices because of, sanctions. But there's still like banks and insurers and logistics people that kind of over comply essentially because they're worried about sanctions and they just don't want to be caught in the red tape. There were a couple of good quotes in the article. This is from the vice president of Brazilian grain farming group AproSoja. Fresh sanctions targeting Russian fertilizer imports could render corn and soybean production inviable. I find that hard to believe, but he's, of course, got to speak for his people and for his base. They had somebody from Mosaic in Brazil, and Mosaic, I think, has cut all ties with Russian suppliers. But they said potential discussions involving retaliation against countries that operate with Russia only end up further aggravating the situation in terms of pricing. We all know fertilizer is very expensive, and these sanctions could perhaps make things worse. It sounds like right now, maybe for Brazil, but it's a global market and it could easily impact the U.S. as well.
U.S. corn shipments fell below pre-report expectations last week. USDA reported that 39 million bushels of corn were inspected for export during the week ending July 17th. The print was down 25% compared to the previous week and down 1% versus the same week last year. Soybean shipments were near the upper end of expectations at 13 million bushels. The print was up a whopping 141% compared to the prior week and up 8% versus the same week last year. Wheat shipments were well above expectations at 27 million bushels. The print was up 65% versus the previous week and up 152% compared to the same week last year.
Yeah, none of this is bad. Everything was above the same week last year. Soybean shipments aren't supposed to be good. Corn's still pretty good. This all looks fine and dandy to me. What did cattle do yesterday?
Cattle futures were sharply higher. Live cattle were $1.67 to $2 higher. Feeders saw gains ranging from $3.50 up to $3.80. Box beef prices were lower. Choice was down $1.48 at $3.7207, and Select was down $1.44 at $3.5005.
Outside markets are quiet this morning. The stock market's mixed, although the S&P 500 did post a fresh all-time high on a closing basis yesterday. Treasuries are off just a little bit. U.S. dollars down just a little bit. Crude oil is down 48 cents in the September WTI at 65.47. Have a great day, guys. We'll be back on Wednesday.